If you ask any great investor what a CEO's most important job is, they'll all tell you the same thing: capital allocation. It's the absolute engine of long-term value creation. And yet, it's a skill that so many leaders just don't have. So today, we're going to break down the framework for how companies raise and spend money, and more importantly, how you, as an investor, can tell if they're any good at it.
All right, here's the game plan. First, we'll dig into why this is such a tough job, even for brilliant CEOs. Then, we'll map out the basic capital playbook that everyone uses. After that, we're doing a deep dive into the riskiest decision of them all: mergers and acquisitions. We'll also tackle the huge economic shift toward intangible assets, and then we'll wrap it all up with a really practical checklist you can use to assess any management team out there.
So first things first, why is this so hard? Well, the core problem is that the skills that get you into the corner office, being a great operator, a fantastic salesperson, those are completely different from the skills you need to be an expert capital allocator. It's a whole new ballgame. And look, Warren Buffett just nails it here. He points out that for most new CEOs, this isn't just another task on the to-do list. It's a massive, critical responsibility that they've probably never dealt with before. And the learning curve, it's incredibly steep. This one skill, right here, can literally make or break a company's future.
And this isn't just an opinion, right? The data is, well, it's pretty staggering. This chart shows that a whopping 98.5% of companies could actually improve their performance just by moving more money around between their different business units. So why don't they? Usually, it's just status quo bias. It's way easier to just keep funding the same old divisions year after year, even when much better opportunities are sitting right there in another part of the business.
Okay, so if it's that tough, let's look at the actual playbook. Every single decision, whether it's for a tiny project or a mega merger, fits into a framework that's actually surprisingly simple.
This table right here lays out the entire universe of options. It's beautiful in its simplicity. Capital can only come from two places. Either the business generates it or you raise it from the market by issuing debt or equity. That's it. And it can only go to two places. You either reinvest it back into the business or you return it to your claim holders. Every financial decision a CEO makes fits somewhere in this grid.
So where did the money actually go in 2024? This chart shows us the reality. And what's really interesting is that the two biggest slices are M&A and something called investment SG&A. Now, that's a key category. It's where all the crucial spending on intangibles like R&D, branding, and software development lives. Remember that, because it's going to be important later.
All right, let's zoom in on that biggest, most high-stakes, and frankly, often value-destroying use of capital: mergers and acquisitions. This is where fortunes are made, and let's be honest, for the buyer, more often lost.
At its core, the math behind a good deal is dead simple. A deal only creates value if the financial benefits you expect to get, the synergies, are worth more than the extra price you paid above market value, the premium. It doesn't matter how great the strategic story is. If you overpay, you lose. The numbers have to work, period. And we've got decades of data on this. We know what works and what really doesn't. As you can see here, deals that create value are almost always paid for with cash. They're smaller bolt-on deals, and they're done by experienced teams who stay disciplined on price. Value-destroying deals, they're the exact opposite. Usually funded with stock, they're big, transformational bets made by inexperienced teams who get caught up in bidding wars. Think Disney buying Pixar versus, AOL Time Warner. So as an investor, how can you quickly size up the risk of a deal? Well, there's a fantastic little metric called shareholder value at risk, or SVAR. It's a simple calculation that asks a brutal question. If all those promised synergies turn out to be zero, how much of our company's value did we just hand over to the other guy's shareholders? A high SVAR is a huge red flag. Now, here's something you're almost guaranteed to hear from management. The deal is accretive to EPS. You need to be incredibly skeptical when you hear this. It's often just an accounting trick. It says nothing about creating real economic value. And look at this number. In nearly half the deals that were sold as being accretive, the market hated it, and the stock went down anyway. And you know what? It pays to listen to the market's gut reaction. This chart, covering over 2 decades, is crystal clear. Deals that got a thumbs up from the market on day one went on to outperform over the next year. And the deals the market disliked, they tended to underperform by a lot. The market's first impression is usually right. Okay, let's switch gears a bit to that other huge bucket of spending, intangibles. The modern economy has seen this massive shift away from investing in physical things like factories to investing in things you can't touch, like software or brand value. The problem is our accounting rules are stuck in the past, and that can seriously distort what a company's real profitability looks like.
So here's the problem this creates. When you calculate a classic metric like return on invested capital using the old rules, you get this really weird, distorted picture. Why? Because those intangible investments, like R&D, get counted as an immediate expense instead of a long-term asset. This makes your invested capital number artificially low, and it gives you this crazy distribution where it looks like tons of companies have either insane returns or terrible losses. It's just not reality.
But look what happens when we fix this. When you adjust the numbers to properly account for those intangible investments, treating them as assets that depreciate over time, the picture gets a whole lot clearer. See how all those crazy outliers get pulled back toward the middle? This gives you a much, much truer sense of a company's actual underlying profitability.
So we've covered a ton of ground here. How do we pull all of this together to actually assess a management team? Let's boil it all down into a powerful 4-step checklist you can use in your own work. Okay, here it is. Step 1, scrutinize their past. Look at what they've actually done with their money over the last 5 or 10 years, not what they say they're going to do. Step 2, measure their true ROIC, making sure to adjust for those intangibles. 3, analyze their M&A discipline. Did they use cash? Was it a sensible bolt-on? Did they stay disciplined on price? And finally, step 4, check the incentives. Is this CEO actually paid to create long-term value for you, the shareholder, or are they just paid to build a bigger empire? At the end of the day, this framework is a powerful lens. It forces you to cut through the narrative and focus on the one thing that truly drives long-term value. So, as we wrap up, I'll leave you with this thought to chew on. Which company in your portfolio just failed this test?